In 2000, one company was worth more than most countries' entire stock markets. Investors called it the future. 18 months later, it had fallen almost 90%. Today, one company is worth more than that whole old market, and almost everyone is calling it the future again. Here's the number that started the whole debate. Nvidia, the company selling the picks and shovels of the AI gold rush, recently crossed a market value of $4 trillion, and at times pushed toward 5. 5 years ago, it was worth under $300 billion. That is one of the fastest run-ups in the history of markets. So the question hanging over every portfolio right now is brutally simple. Is this a once-in-a-generation boom you'd be insane to sit out, or a once-in-a-generation bubble you'll spend a decade regretting? Both can't be true. So let's actually look at the evidence. Even the man building the biggest AI company on earth admits the word fits. Sam Altman, who runs OpenAI, said out loud what a lot of people are whispering, that investors as a whole are overexcited, and that someone is going to lose a phenomenal amount of money. When the chief booster says it's a bubble, you pay attention. This is a clear-eyed look at the bubble question, the spending versus the revenue, the valuations, the dot-com parallel, and the strongest version of both the bull and bear case. No hype, no doom, just what the numbers say. Let's get into it. Start with the single most important fact because everything else hangs off it. The amount of money being poured into AI is almost impossible to picture. In 2026, the 4 biggest American tech companies plan to spend somewhere around $400 billion in capital expenditure, mostly on AI data centers and chips. Just a few years ago, that combined number was under $150 billion. The spending didn't grow, it exploded. Zoom out and the figures get surreal. Across the whole industry, analysts estimate something like $1.5 trillion will be committed to AI infrastructure over the next few years. That is more in real terms than the United States spent building the entire interstate highway system on data centers. And here's the line that should make any investor sit up. A respected Wall Street analyst estimates the industry needs to generate around $600 billion in new annual revenue just to pay for the chips and data centers being built right now. $600 billion every year to break even on the hardware. So how much AI revenue actually exists today? Estimates vary, but OpenAI, the biggest pure play of all, is running at an annualized rate of roughly $20 billion. That's real, and it's growing fast. But against $600 billion of spending, you can see the gap. The bill is being run up years before the revenue shows up. Put those two numbers side by side, and you have the entire bear case in one image. Hundreds of billions in revenue being generated against well over $1 trillion in spending already committed. The believers say revenue will sprint to catch up. The skeptics say that's exactly what people said in 1999. The chief executive of JP Morgan, Jamie Dimon, framed the risk in a way that's worth sitting with. He's not saying AI is fake. He's saying the money will not all be spent well. That a lot of capital, as in every boom, is going to be set on fire before the winners emerge. Okay, but huge spending alone doesn't make a bubble. A bubble is about price. So the real question is, how expensive are these stocks really? Here's the surprise that cuts against the doom. Nvidia, the poster child of the boom, trades at roughly 30 to 40 times forward earnings. That's expensive, but it is nowhere near insane. At the peak of the dot-com bubble, Cisco, the Nvidia of its day, traded at over 130 times earnings on far less profit. That distinction matters more than anything else in this whole story. The dot-com darlings made almost no money. They were priced on dreams. Today's AI leaders are some of the most profitable companies in human history. Nvidia's net margins run above 50%. This bubble, if it is one, is built on real cash flow. But concentration is its own kind of risk. The so-called Magnificent Seven tech giants now make up around a third of the entire S&P 500. That means if you own an index fund, and almost everyone does, you're far more exposed to this one bet than you probably realize. The whole market is leaning on a single trade, and by some broad measures, the market overall looks stretched. One closely watched gauge, comparing total stock value to the size of the economy, sits well above where it was even at the dot-com peak. That doesn't mean a crash is coming tomorrow, but it does mean there's very little margin for disappointment, which is why even some of the biggest believers are hedging. The CEO of Alphabet, Sundar Pichai, gave the most honest two-sided answer of anyone, admitting that no company, including his own, would be immune if the air came out of this thing. So let's go straight to the comparison everyone reaches for, the dot-com crash of 2000, because the parallel is real, but so are the differences, and they cut both ways. Here's how bad it actually got. From its peak in March 2000 to the bottom in October 2002, the tech-heavy Nasdaq fell 78%. Not 20, not 40, 78%, and it took 15 years to climb back to its old high, a whole career's worth of waiting. And here's the part people forget. The internet skeptics were completely wrong about the technology, and completely right about the stocks. The web did change the world. It did create some of the most valuable companies ever. And investors who bought the hype at the top still got destroyed. Being right about the future is not the same as making money on it. But look closer, and the errors diverge. In 2000, the boom was funded by easy IPO money and debt poured into companies with no revenue and no profit. Today's build-out is being funded mostly by the cash flow of the most profitable companies on earth. That is a genuinely sturdier foundation. The fuel is different. There's one crack worth watching, though. The new wave of AI data centers is increasingly being financed with debt, private credit, and bonds, not just spare cash. Estimates for AI-linked borrowing already run into the hundreds of billions. Debt is what turns a correction into a crisis. That's the one .com echo getting louder. The legendary investor Howard Marks put the right frame on it. The question, he says, is never just, is it a great technology? It's always, how much are you paying for it? A wonderful business at a terrible price is still a terrible investment. That single idea is the whole ball game. So let's do this honestly. Lay out the strongest version of each side, not the straw man, the real argument, and let you decide which one you find more convincing. The bull case is genuinely strong. 1. The technology works and is already inside hundreds of millions of daily lives. 2. The buyers are profitable giants spending their own cash, not fragile startups. 3. Even skeptics agree AI demand is real and enormous. The bull doesn't need a miracle, just for a useful tool to keep getting more useful. The bear case is just as serious. 1. The spending dwarfs the revenue, and that gap has to close fast. 2. The whole market is dangerously concentrated in a handful of names. 3. More and more of the build-out is funded by debt. The bear isn't betting AI fails, just that the price ran too far ahead of the payoff. And the honest middle ground? Both can be true. After the .com crash, the survivors with real business models delivered some of the greatest returns ever. Amazon itself fell about 95%, then rose more than 1,000-fold from the bottom. The internet was both a bubble and the opportunity of a generation. So the lesson of 2000 isn't avoid the technology, it's survive the price. The people who got hurt weren't the ones who believed in the internet. They were the ones who paid any price for it, borrowed to do it, and couldn't hold when the floor fell out. The danger was never the idea. It was the leverage and the entry point. So forget trying to call the exact top. Nobody can. Instead, here are the concrete signals that would actually tell you which way this is breaking. Watch these, not the headlines. Signal 1, the one that matters most. Watch the revenue. The whole bull case rests on AI sales racing to catch the spending. If revenue growth keeps compounding at the triple-digit rates we've seen, the bulls win. If it stalls while capex keeps climbing, that gap becomes the story, and it gets ugly fast. Signal 2, capex discipline. Right now, Wall Street rewards big tech for spending more. The day that flips, the day investors start punishing the stocks for huge capex instead of cheering it, is the day the psychology of the boom changes. Watch the market's reaction to spending, not just the spending itself. Signal 3, the debt. As long as the build-out runs on cash, a slowdown is painful but survivable. The more it runs on borrowed money, the more a simple disappointment can cascade into something worse. Watch how much of the next wave of data centers is funded by debt versus profits. That ratio is the fragility gauge. And keep one piece of market history taped to your screen. The economist Rudy Dornbusch's famous line about manias, that things take far longer to happen than you think they will, and then they happen far faster than you thought they could. Bubbles always feel like they'll never pop, until suddenly they do. So here is where it all nets out. This is almost certainly both things at once, a real world-changing technology, and a market that has, in places, gotten ahead of itself. The internet was exactly that in 2000. The trick was never picking a side. It was respecting both. The technology is real, the opportunity is real, and so is the risk that the price has outrun it for a while. So the only question that actually matters for your money isn't, is AI a bubble? It's this. If these stocks fell 70% tomorrow, like the Nasdaq did, could you hold on? Be honest with yourself about that answer. If this gave you a clearer, calmer way to think about the AI bubble debate, do me a favor and follow Market Minute. Next time I'll break down exactly how the .com survivors made it through the crash and what that playbook means for today. I'll see you there.